Well, it is still earnings season. We're going to be talking about Shopify in not too long. But with over 80% of the S&P 500 already turning in their reports, our next guest has been tracking the results and breaking them down. Carey Hall is head of U.S. Small Mid-Cap Strategy at Bank of America Securities, and she joins us now. Thanks so much for making time today.
Thanks for having me.
So we're still in the thick of earnings season here, but how would you characterize what we've seen so far?
Look, I mean, results have largely come in as expected and actually slightly weaker than expected. I think, when we look at results so far for the S&P 500, guidance has been weak. So, corporates are optimistic, but currently conditions are weak. And, when we look at results by sector, one area that we've been cautious on that we continue to be cautious on is tech. That was obviously, one of the sectors that missed expectations this quarter. We've seen a lot of headlines around layoffs within the tech sector, but we still think that the tech is, the labor relative to how fast their sales have been growing is still relatively too high. So they've still overhired. And that's an area where we think a lot of the benefits to tech have been reversing. You talked about, higher interest rates after decades of low interest rates, globalization potentially peaking. So, that's one sector that from what we saw this earnings season, we're still cautious on. Overall, we also think that expectations for overall earnings to the market are still too high. We are expecting a mild recession starting later this year. And, consensus analysts are still expecting slightly positive earnings growth for the market this year. We think growth will be negative. So even amid the weakness and estimate cuts we've seen, we still think there's more to come.
When you're tracking these expectations, Jill, do you have a way to sort of gauge how they shift and how they change, in terms of those expectations being lowered as we perhaps near earnings season like this one that we're in?
Right. Usually the, consensus analyst expectations start too high and come down into the quarter. And that's what we saw. And into this quarter, the pace of estimate cuts was about double what we usually see. So analysts did slash their numbers much more than usual heading into the quarter. Despite that, numbers still came in lower than expected. Maybe not really a big surprise. But we do think, even amid the miss this quarter, when you look at the, second quarter, third quarter out in this year, the expectations we still think are too lofty. So we do expect more downward revisions. Guidance, as I mentioned, from corporates has still been negative. There have been some bright spots, though. Margins, we have seen margin compression, but only about 20 basis points this quarter. So, you have seen resiliency from corporates. Capex spending is one area that we think will hold up, much better even in a recession than it typically would. So S&P 500 companies are spending on, structures and capacity. So their spending was up almost 20% year over year. And I think there's a lot of reasons corporates have to spend right now, whether it's, reshoring of U.S. manufacturing, making their supply chains more transparent, spending on automation amid all of the labor pressures that we've seen, spending to get to net zero, so ESG related spending. So that's an area that, has been a bright spot and that should benefit some of the stocks that are more Capex sensitive or, domestic small caps tend to be sensitive to Capex as well.
When it comes to that spending, though, if it requires borrowing, then there's those higher rates. And then if, there is a potential recession on the horizon, wouldn't that be something that would make a company want to hit pause and just sort of wait things out for a bit?
Right. I mean, Capex is typically cyclical. So to some extent, you do tend to see it slow during recessions. But we think given all of those reasons that we just mentioned, companies will, have more reason to spend on Capex than usual. Corporate balance sheets are generally healthy. So for many companies, they may not need to borrow to spend. And I think when you look at how corporates have spent their money over the last decade, they've really underinvested on Capex and even, dividends have lagged since COVID in terms of, the recovery in dividends has lagged earnings. Buybacks have really been where corporates have spent their money. And, we actually think that, you'll see a shift toward, less spending on buybacks and more spending on dividends and capex. So there can be that shift within their allocation as well.
Just to come back to the tech part of things, Jill, there's been a lot of interest in AI recently. Do you see that part of technology perhaps having, more potential going forward in terms of growth?
I think overall tech is a sector that, when there's secular themes and even stocks tend to be more idiosyncratic, move less together relative to sectors that are more macro driven. So, tech is certainly a sector where there can still be secular and thematic opportunities. And we actually think that this is going to be a good backdrop for stock picking and active management this year, relative to we were in a very, macro driven backdrop for several years, COVID and the Fed and inflation. So assuming that central banks are able to get inflation under control, we think there's just a lot of cross currents within the market right now that are really going to drive differentiation between stocks and sectors. So a good time to be more active in terms of, investment management.